Hey everyone, welcome to the Copilot Exchange. This is Steven, and in this video I want to teach you the basic structure of candlesticks when charting for stocks, and also some of the advantages, once you understand how a candlestick works, some of the advantages of using candlestick charting to select more accurate entry and exit points in your investments. So let's get started. I just drew up two candlesticks here, and you can see they're both the same shape. But what is a candlestick just in general? A candlestick is actually just a representation of time with price action, time combined with price action. So both of these candlesticks each individually represents a 30-minute time frame where the price would have swung all the way up where you see my mouse is and all the way down here. So let's kind of explain a little bit more of the structure behind what makes a candle a candle. You've got a basic structure here of a body, which is this larger, wider part, and the wick. And just think about wicks as like a tracing line, a line that followed the price action, but not necessarily where the price action is right now. It's where it used to be. Think about it like that. So what makes the candle green and what would make it red? What's the difference here? Well, in order for a candle to be green, the closing price of this 30-minute time frame needs to be above where the opening price was. So the opening price would have been here, the closing price would have been here, and that formed the body between the opening and closing price. Now in that 30-minute time frame, a lot of other price action occurred, but this is just where we ended up at the close. The price action actually went all the way up to a high and then all the way down to a low as well. Now, not all candles are going to look like this. They're not going to have wicks coming off of both ends all the time, but this is the basic structure. So with a red candle, you basically just invert this methodology, which is if a candle ends up red, what does that tell you? That means that the price closed below the open, not above. So we opened up here, and then we closed below the open, which caused the candle to be red. Once again, that formed the body of the candle. But the price action actually went all the way up here to the high and all the way down here to the low. So same exact shaped candles, two different colors, and they tell you two completely different stories. And once again, for all of my examples in this video, I'm going to be using 30-minute time increments for my charting, just to keep things simple. So let's back out of this and take a look at a little bit more of a real type of example on an actual chart. So in this chart, I just basically made a very basic chart, and for me, I trade a lot of pennies, so I made it up to $1, 10-cent increments up the right side, and across the bottom you can see we're moving in 30-minute increments, as I mentioned. So let's say the bell rings in the morning at 9:30, and we open at 40 cents. So that's our open. Okay, now let's say the price goes all the way up to 70 cents. Now because the price went above, it traveled above the open, it's still green. You notice the candle's green. But also the wick will follow that price action. Now let's say it retraces a little bit, pulls back a little bit. Now we've formed a wick. Now let's say we pull all the way back to 30 cents. What would happen to the candlestick's color if we went to 30 cents? It would actually technically become red, wouldn't it? Because we're below the open now. So let's say we go all the way down to 30 cents, we're red now. The wick would actually be red as well. I'm just not drawing it out red to save a little bit of time. But then we retrace and we go to 50 cents, and that's where the price closes for that 30-minute time period. And because it closes at 50, above our open at 40, we are now a green candlestick. So just a quick review, we opened at 40, we closed at 50, we went to a high of 70 and a low of 30. Okay, so let's say that time frame of 30 minutes has closed and we open up a new time frame at 10 o'clock. So this is our new open. We open at 50 cents at 10 o'clock. And the same exact kind of process can happen. Let's say we go up first. Well, if we go up above where the opening was at 50 cents, this candle would actually be green, wouldn't it? Because we're going above the open. So we're up here, and once again, I'm going to draw the wick to trace this price action, if I can get my mouse on it, all the way up to 70 cents. And let's say we pull back to 30. Well, if we're back to 30, let's say the price action goes all the way back down to 30, the candle would turn red again, first of all. The wick would follow it. And let's say we're 5 minutes before 10:30 and the candle's about to close and it pulls back to 40 cents. Well, we still, let's say that we closed there at 40 cents, we would still be a red candle because we closed below the opening. And once again, the high was the same as the previous candle at 9:30, and so was the low, but the colors of the candles are completely different, and they tell you a completely different story. But to really drive this point home, I want to use a real-world example and show you the difference when you're looking at a line chart for a stock, and then similarly when you're looking at a bar chart for a stock. So I'm gonna kind of just mute some of these lines that I've drawn. We're going to take a look at YRIV. It's just a stock I've been involved in lately in the last couple of weeks. And look at what happens here in the 16th of April to the 17th opening of April. We drop from $1.38 down to what seemingly looks like about $1.15 in the morning. Now, what are we missing here? Well, if you're looking at this chart, you might be thinking, well, it dropped and it bounced off $1.15 because I see previous support here on April 5th. Maybe it's just like acting as a line of support. It's very true. It could be acting as a line of support, but we're missing a lot of information. And let me show you what I mean by that. Wow, if we look at the candlestick version on the 30-minute increment time frame, we see that there is a massive drop, and we actually opened at 96 cents. There was a high of $1.30 and a low of 87 cents, and then at the end of that 30-minute increment, or the 30-minute time frame, we closed at $1.15. So what am I trying to tell you here is that a line graph is only showing you the closing price of a time frame, of the 30-minute time frame. It just shows you one aspect, one variable out of 4 possible variables in that 30-minute time frame. And so you have a much shallower understanding or viewpoint of what actually was occurring in the price action if you're looking at a line chart. Now, what else did I glean from this information? Well, I spotted some gaps, and I also have some other videos that I've made about gaps if you want to check them out. But look at this gap that formed. I actually use gaps as an indicator of whether or not I should be making an entry or an exit into or out of a stock. And so let me show you these lines that I drew, these gaps that I found. I would not have been able to locate these once again on a line chart. It would have looked like solid price action just sliding from $1.38 down to $1.15. The reality was that a large void was formed here, and I would never have been the wiser if I wasn't using a candlestick chart. So this is one example of many of the higher level of resolution that you can get by using candlesticks. And hopefully these can become stronger solid indicators for you in terms of where you want to make your first entry and your final exit into and out of a stock. So I hope you learned something from this video, both on the structure of candlesticks and also some of the advantages of using candlesticks as opposed to line charts. And I will be following this up with some more detailed videos on candlestick formations and just some more advantages of using this type of charting structure. So hope you join me again, and I will see you on the other side.